Okay, it's Thursday, February 5th, 2026. And if you've uh, dared to log into your brokerage account in the last 48 hours, you probably have that distinct sinking feeling in the pit of your stomach. You know the one where the numbers are all red, the news tickers are flashing, and the financial world just feels like it is completely turned upside down.
It doesn't just feel like it. I mean, it actually has. We are watching history books being written in real time this week.
And that is exactly why we're doing this deep dive today. We need to talk about what everyone is calling the Great Unwind. Because for the last, 20 years, we've all been living in a place the strategists call zero land.
Zero land. It sounds like a bad theme park, doesn't it?
It really does.
But it was this, this comfortable, maybe fictional place where G7 debt, we're talking U.S. treasuries, Japanese government bonds, was considered completely risk-free.
All bedrock.
The bedrock. It was illiquid, it was costless, and it was the foundation of every single investment strategy on Earth.
So the idea was, look, no matter what happened, you could park your money in U.S. or Japanese government debt, sleep soundly, and, well, wake up richer.
Precisely. But the news flash for today. Zero Land is officially dead. The park is closed. What we're seeing this week is a violent transition from a market driven by liquidity.
Where central banks just suppressed all the volatility.
Right, to a market that's now driven by solvency.
Solvency, that's a much heavier word.
It is. Investors are suddenly looking at the United States and Japan, and they're asking a very scary, very basic question. Can these nations actually pay their bills without, printing their currencies into oblivion?
That is a terrifying shift in psychology. So, to guide us through this chaos, we've got a massive stack of research from this week, February 2026. We're going to dissect the two main drivers of this explosion.
The first is the Takaichi trade in Japan, which, you're right, sounds like a thriller novel, but is actually an economic earthquake.
And the second is the open political warfare happening right now against the Federal Reserve here in the U.S.
And our mission today is pretty simple. We need to explain why the risk-free rate isn't risk-free anymore, why your standard 60-40 portfolio is, frankly, failing to protect you, and where the smart money, the central banks themselves, is actually running to hide.
Okay, let's unpack this. We have to start in Japan. Usually when we talk global finance, eyes glaze over when Japan comes up because, nothing ever happens there. It's been stable, low yield, boring.
Boring is the word.
But right now, it's the absolute epicenter of this crisis.
It is, and it all centers on one person, Prime Minister Sanae Takaichi.
She's being called the catalyst for this whole rupture. But Japan has had aggressive leaders before. What is she doing that's so different?
She has completely rejected the old playbook. For 30 years, Japan was stuck in this loop of fiscal austerity and battling deflation. Takaichi came in with what she calls a high-pressure economy agenda.
High-pressure economy. That sounds a little bit like code for we're going to run the engine till it smokes.
That is exactly what it is. She wants growth, she wants it now, and she simply does not care about the debt levels. She actually dissolved the lower house and called for snap elections for this coming Sunday, February 8th.
So she's looking for a mandate to spend.
A massive one. And she's not waiting for the votes to start spending. Look at the numbers on the stimulus package you've got there.
Yeah, I'm looking right at it. 21.3 trillion.
It's huge, and look where the money is going. 11.7 trillion is just cost of living subsidies, suspending the food tax, energy subsidies, then huge spends on AI and semiconductors, and a record defense budget. It's a spending spree on a credit card that's already maxed out.
But this is where the math gets really scary, and I want you to walk us through this. The budget for fiscal year 2026 is 122.3 trillion. But their projected tax revenue, it's only a teeny 3.7 trillion.
Right. You don't need a PhD in economics to see the problem there.
Yeah.
That is a massive gap, a deficit of nearly 40 trillion yen.
So roughly a third of the entire budget is just unfunded.
Exactly. And how does a government fill a deficit? They can't just wish it away. They have to issue bonds. They have to borrow it from the market.
And the bond market took one look at this plan and, absolutely panicked.
Panic is the right word. For decades, traders called shorting Japanese bonds the widowmaker trade.
Yeah, because everyone who bet against Japan just lost their shirt. The Bank of Japan would just step in and crush them every single time.
Every time. They'd just buy the bonds and keep rates at zero. But now, the widowmaker lives. The zombie has risen. The trade is finally paying off.
Why now?
Because with this much new debt hitting the market and with inflation rising because of all the stimulus, investors are demanding a much, much higher yield to hold Japanese paper.
And the numbers here are just eye-watering for a developed bond market. The 30-year JGB yield jumped 30 basis points in a single session.
That's a lifetime of volatility in one day for Japan. It's now sitting around 3.57%. And the 40-year yield, this is the big one, it breached the psychological 4.0% barrier.
Okay, I want to pause on that. 4% sounds low if you're, used to U.S. rates or looking at a savings account. But for Japan, that's seismic. But help me understand, why is this a catastrophe? If I hold a bond and the yield goes up, isn't that good? I'm getting paid more interest.
If you're buying it today with fresh cash, sure, it's great. But think about the pension funds, the insurers, the banks who already own trillions of these bonds. This is the value at risk shock.
Okay.
Bond prices move inversely to yields. When the yield goes up, the price of the bond goes down.
So it's a seesaw.
It's a seesaw, exactly. And on a really long-term bond, like a 40-year JGB, that seesaw is incredibly sensitive. When the yield jumps from, say, 2.5% to 4%, the price of that bond doesn't just dip, it crashes. We're talking 30, maybe 35%?
Ouch. So if you're a Japanese pension fund holding these safe assets to pay for retirees, you just lost a third of your principal value overnight.
Precisely. It is a bloodbath in what was supposed to be the safest part of the portfolio, and that's when solvency issues start to creep in.
Okay, so Japan is having a meltdown, but I can hear the listener in Chicago or London or Sydney asking, why does a Japanese bond yield matter to me? I don't own JGBs.
And here is where it gets really, really interesting. This is the concept of repatriation. You have to understand that for 20 years, Japanese institutions, the Post Bank, the huge life insurers, they were the investors of last resort for the rest of the world.
Because yields were zero at home, right? They couldn't make any money in Tokyo, so they had to go shopping in New York or Frankfurt.
Exactly. They bought U.S. treasuries, French bonds, Australian debt. They own trillions of dollars of foreign assets. But now, look at the board. They can get 2.2% to 4.0% at home in their own currency with zero currency risk.
So the incentive to leave Japan is just gone. But is it just about preference? Or is there a more mechanical reason they're leaving the U.S.?
Oh, there is a brutal mechanical reason, and it all comes down to hedging costs. If you are a Japanese insurer like Nippon Life, and you buy a U.S. Treasury that's paying, let's say, 4.5%, you have a problem. You have to hedge the currency risk, right? So a drop in the dollar doesn't wipe you out.
Right. You need insurance on the exchange rate.
But the cost of that insurance is tied to short-term U.S. interest rates. And because the Fed has kept short-term rates high, that hedge costs maybe 3%. So you take your 4.5% U.S. yield, subtract the 3% hedge cost, and you're left with 1.5%.
Wait. So I'm doing all this work, taking on U.S. risk for a net 1.5%, when I could just buy a Japanese bond and get 2.5% or 3% completely risk-free.
Exactly. The math is broken. Buying U.S. debt is now a losing trade for them. So the money is coming home. It's a giant sucking sound.
Yeah.
And we're seeing it in the data explicitly.
Like where?
Japan Post Bank, one of the biggest investors on the planet, has officially shifted its strategy. They are moving cash and selling foreign securities to buy JGBs. They added over $870 billion to their domestic bond holdings just recently.
And that creates what this report calls a global liquidity hole.
Yes. Japan is the world's largest creditor. When they call in their loans, that liquidity vanishes from New York and London. We actually saw this with the yen carry trade Unwind back in January.
It was that margin call cascade, right? The yen strengthened and everyone just panicked.
Right. The yen went from 158 to 152 against the dollar, like in a flash. And everyone who had borrowed cheap yen to buy U.S. tech stocks or treasuries got margin called. It's a chain reaction. Japan raises rates, money leaves the U.S., and suddenly there are no buyers for U.S. debt.
Which brings us perfectly to the United States, because if Japan is the earthquake, the U.S. seems to be suffering from a structural collapse of its own. It's not just about Japan leaving, it's about what's happening in Washington.
It's a very different kind of crisis. Japan is dealing with an economic repricing. The U.S. is dealing with a crisis of institutional credibility. The market is looking at the Fed and the White House and realizing the guardrails are gone.
Let's talk about this bear steepening. I keep seeing this term in the headlines. It sounds like a bad day at a zoo. For the non-trader, what does that actually mean?
It's the worst possible setup for a bond market. Usually when interest rates rise, it's because the Fed is hiking short-term rates to fight inflation. That flattens a curve.
Okay.
A bear steepening is different. It means short-term rates are staying put, but long-term rates, the 10-year, the 30-year, are skyrocketing.
And we saw that on February 2nd. The 10-year Treasury hit 4.276%, and the 30-year almost touched 5%.
And that move wasn't about inflation data. It wasn't about economic growth. It was about risk, specifically a political risk premium. Investors are demanding to be paid more to lend money to the U.S. government for 30 years because they are terrified of the politics.
This brings us to the war on the Fed. We have to talk about this Supreme Court case, Trump v. Cook. This feels completely unprecedented.
It is entirely unprecedented. President Trump is trying to fire Federal Reserve Governor Lisa Cook for cause.
Now, in the past, cause usually meant, you embezzled money or you just didn't show up for work. It was a very high bar.
A very high bar. But the administration is arguing that cause includes policy disagreement. They're using some disputed mortgage fraud allegations as a kind of pretext, but the legal argument is that the president should be able to remove a governor who isn't following the administration's economic goals, if the Supreme Court agrees.
If they agree, the Fed is basically finished as an independent institution.
It becomes just another arm of the Treasury. And markets hate that because politicians always want lower rates, even if it causes runaway inflation.
And the pressure campaign gets even weirder. The Department of Justice has issued subpoenas to the Fed regarding renovation costs.
Yeah, investigating a $2.5 billion renovation of the headquarters. Chair Powell is calling it an intimidation war.
Wow.
It's stunning. You have the DOJ effectively raiding the central bank to pressure the chairman to resign or cut rates. It's the kind of thing you see in, emerging markets or banana republics, not the issuer of the global reserve currency.
And while this is all happening, you have this shadow Fed just waiting in the wings.
Right. The market sees who is next. Kevin Warsh has been nominated to replace Powell, and Stephen Miran is already on the board.
Miran is the one who votes for aggressive cuts at every single meeting, isn't he?
Every single time. And the message is crystal clear. The future Fed will be pliant. They will print money to fund the debt. This is what we call fiscal dominance.
Okay.
The Fed stops caring about inflation and starts caring about making sure the government can afford its debt payments.
And that's why the bond vigilantes are selling. They know the future involves printing money to cover these deficits. And we're actually seeing the plumbing of the market itself start to clog up because of this.
We are. You look at indirect bidding at Treasury auctions. That's usually foreign central banks buying the debt. It's dropping off a cliff. Foreigners just aren't showing up. And get this, the Treasury is actually having to change the math they use to calculate the yield curve.
They're changing the math.
They are switching to something called a monotone convex spline method.
Whoa, hang on. Monotone convex spline. That sounds like something you'd make up to confuse a calculus student. What does that actually mean in plain English?
It's essentially a smoothing filter. Think of it like an Instagram filter for bond yields. The old math was showing these jagged, ugly spikes in the data places where no one wanted to buy the debt at the offered price.
So the market was screaming no, and the math was actually showing that volatility.
Exactly. And instead of fixing the debt problem, they just changed the formula to smooth out the jagged edges. They are literally smoothing over the cracks in the foundation so the chart looks pretty.
That is deeply concerning. When you have to change the math to make the bond market look functional, you know you're in real trouble. So, Japan is going home. The U.S. is politicizing its currency. This leads to the sell America narrative. Who's selling?
Well, China is the big one. We've known this for a while, but the acceleration is real. They've gone from holding over $1 trillion in treasuries to just $682.6 billion.
That is a massive drop. Almost half their stack is gone.
And it's strategic. They saw what happened to Russia's assets after the sanctions. They know treasuries are a liability if you get into a geopolitical spat with Washington, but it's also the weak dollar policy coming out of the White House.
Right, the president keeps saying he wants a cheaper dollar to help with exports.
He wants the lowest interest rates anywhere. But just think about the logic there for a second. When the president of the United States actively tells the world, I want my currency to be worth less, foreign investors listen.
Sure.
They say, okay, if you want it to be worth less, we won't hold it.
So where do they go? If you can't trust treasuries? And JGBs are melting down. I mean, where does the smart money go?
To the only asset that isn't someone else's liability, gold.
It finally broke $5,000 an ounce.
It surged past it. And this isn't, people buying coins on TV infomercials. This is central banks, India, Brazil, China. They are strategically rotating out of dollars and into physical gold.
The report called it the sovereign bond of no nation. I love that phrasing.
It's perfect, isn't it? In a world where G7 bonds have political risk, where the US might default or inflate, and Japan is insolvent, gold is the neutral reserve asset. It's the only thing that can't be devalued by a tweet or a stimulus package.
Before we wrap up, there was one other weird anomaly in the data that I wanted to ask you about. We saw Treasury yields skyrocket, but mortgage rates, they fell. That defies financial gravity. Usually they move together.
That is the smoking gun of market manipulation. Usually mortgages trade at a spread over treasuries. If treasuries go up, mortgages go up. But in January, the 30-year fixed mortgage dropped to 6% while the 10-year treasury rose.
How is that even possible?
Direct government interference. The administration explicitly encouraged Fannie Mae and Freddie Mac to buy more mortgage-backed securities to prop up the housing market before the election.
So they are artificially suppressing mortgage rates to keep voters happy.
Precisely.
Yeah.
But think about that contradiction. You have the government subsidizing housing debt while its own sovereign debt is crashing. It just proves that the price signals are completely broken. The market is no longer free. It's being managed.
So let's bring this all home for the listener. We've covered Japan's stimulus rupture, the global liquidity hole, the war on the Fed, and this flight to gold. If we synthesize this great unwind, what's the actual takeaway for someone looking at their 401k right now?
The big takeaway is that we are moving from a single globalized capital market to a segmented one. Capital's going home. The era of zero land, of easy, risk-free returns on government bonds is over.
So what are the red flags? What should people be looking out for in their own portfolios?
First, you have to realize that duration is dangerous. Long-term government bonds used to be the safety net in your portfolio. When stocks fell, bonds went up. That correlation is now breaking.
So they can fall together.
They can, and they are. Because of inflation and debt fears, the classic 60-40 portfolio, 60% stocks, 40% bonds, is effectively broken in this environment.
It's not hedging anything.
It's failing to hedge risk. Secondly, pay attention to hard assets. The signal from the central banks is loud and clear. Own things that cannot be printed. Gold, infrastructure, commodities. If the people running the printing presses are buying gold, you should probably pay attention.
It sounds like trust is the commodity that's really in the shortest supply right now.
It is. And lastly, you have to think about diversification away from just the dollar. It's not about the dollar collapsing tomorrow, but it is about the weaponization of the currency and all this political instability. You need exposure to other currencies, maybe the Swiss franc, or just real assets that aren't denominated in dollars.
It's a brave new world.
It's a solvency-driven world. The
Yeah.
bill has finally come due.
I want to leave everyone with a final thought here. We always talk about the risk-free rate, the return you get on a U.S. Treasury. It's the gravity of the financial world. It's the number that every other asset is priced against. Stocks, real estate, corporate bonds, they're all priced based on that one baseline.
That's Finance 101. Everything spreads off the Treasury yield.
But what if that baseline?
Yeah.
What if that risk-free rate now carries political risk, if it carries inflation risk? If the very foundation is cracked because the DOJ is raiding the Fed and foreigners are fleeing?
Then the whole house is built on sand.
Exactly. It means that right now, as we speak, every other asset in the world, your tech stocks, your house, your corporate bonds, might be fundamentally mispriced. We aren't just seeing a market correction, folks. We are seeing the receipt for 20 years of zero land finally hitting the table.
And unfortunately, we're the ones who have to pay it.
Thanks for diving deep with us. Keep your eyes on those yields, watch the Japanese Open, and we'll see you next time.